What's up everybody, Genix Dividend Investor here. I think you'll find a lot of value in this video as I tell you which of my dividend stocks I believe are cheap right now. I'll also respond to a Crabby commenter who told me that my 4% current yield in my dividend portfolio is pathetic. Finally, I'll end this by explaining how a stock's price gravitates towards its intrinsic value, which is a very important investing concept to really understand. Oh, and I'll tell you about my favorite Christmas present I got this year. But first I'd like to say Happy New Year and welcome to 2025, and I hope everyone has had a nice time off for the holidays. Feel free to use the timestamp on screen if you want to jump straight to the stocks, but I encourage you to not skip ahead. Okay, so at the start of every new year, I recommend that you take a moment to reflect on the things you have and the aspects of your life that you can be truly grateful for. There's a great quote that goes, "Learn to appreciate what you have before time makes you appreciate what you had." I can tell you that pretty much everyone who has been around the block a few times knows how true that statement is. Unfortunately, most people don't really value what they have and instead are mostly focused on what they don't have. But the reality is that eventually your future self would probably do almost anything to be able to go back to where you are right now, this very moment, which means that you're currently living in a time that your future self would think of as the good old days. Now sure, some of you might be experiencing some really challenging things right now, but regardless, I urge you to find something good in your life. Be happy that it's raining outside and that you have shelter over your head, or maybe that it's sunny and you can see the blue sky, or hear the birds, or maybe just appreciate the fact that you can smell the bread in your toaster oven. That quote about appreciating what you have was actually shared on my free dividend Discord by a Patreon aristocrat of mine named Sublime, and one thing that he is grateful for right now is the fact that he and his wife just had a new baby boy born on Christmas Eve. Congrats buddy, I'm really excited for you guys. Sublime likes to share motivational quotes on my Discord, and he also shares stock futures before the market opens, which everyone on my server appreciates. Anyway, if you're new to my YouTube channel, then welcome, and if you want to see my entire dividend portfolio in fidelity, then watch a video I did last month called my $3.3 million dividend portfolio, $131,000 of dividends per year. In this video I'm going to quickly go through all 28 of my tickers, and I'll categorize them as cheap, reasonably priced, or expensive in relation to what I believe their intrinsic value is. Usually I'm okay to do larger lump sum buys if something is cheap and I want it, and I often avoid investing when things are expensive. I'm often okay to dollar cost average into reasonably priced things and into ETFs. And right now I'm getting over a little bit of a cold, so sorry about that. Sometimes people mistakenly think that trying to wait for a stock to be cheap is the same as market timing, but it isn't. Market timing usually involves predicting short-term market movements and buying or selling stocks based on those forecasts. It's often influenced by external factors like macroeconomic trends, interest rates, or geopolitical events, and in my opinion is highly speculative and prone to error, as market movements are notoriously hard to predict. But buying a stock when it's cheap focuses on the intrinsic value of individual stocks, seeking undervalued companies based on their fundamentals. It relies on analysis of things like cash flow and growth potential to determine if the stock is priced below its worth, and it operates under the belief that stocks usually will trend towards their intrinsic value over time. Of course, there is risk with all investing strategies, and misjudging intrinsic value or assuming a cheap stock will recover when it might not is something to be aware of. So in short, market timing is about guessing the market's next move, while buying cheap stocks is about identifying value regardless of broader market conditions. I frequently will do a discounted cash flow or DCF calculation to determine a stock's intrinsic value or true worth. It's important to understand that a DCF calculation is based on assumptions about future cash flows, growth rates, and discount rates, and since those assumptions are inherently uncertain, that means the calculated intrinsic value is not absolute or definitive, but rather an informed estimate. So TLDR, a DCF is a way to figure out what a stock is worth today by estimating how much cash it might earn you in the future, and is a somewhat subjective exercise. I mean, the DCF formula itself is objective, but some of the numbers you use in it are subjective. So you start with the company's current cash flow and estimate how it might grow over the years by applying a growth rate. Then you apply a discount rate to account for the time value of money and risk, which helps determine the present value of the company's future cash flows. The time value of money means that a dollar today is worth more than a dollar in the future because you can invest that dollar now and earn a return, which is a concept that accounts for the opportunity cost of not having money today. Like if you have $100 today and you can invest it at a 5% annual return, it will grow to $105 in a year. But $105 a year from now is only worth $100 today because you could invest $100 now and end up with the same $105 in a year. Hopefully that makes sense. Okay, and the risk aspect of DCFs refers to the uncertainty about whether future estimated cash flows will be realized as expected. Basically, investments are never guaranteed to perform as predicted, so risk factors like market volatility, competition, economic changes, etc. are all attempted to be accounted for by adjusting the discount rate, a subjective input. A riskier investment has a higher discount rate because future cash flows are less certain, making them worth less today. A stable, less risky investment has a lower discount rate, reflecting higher confidence in receiving the projected cash flows. Bottom line, a DCF valuation involves projecting a company's growth, discounting its future cash flows to determine today's intrinsic value, and comparing that to its market value to guide investment decisions. And that quick DCF primer should help you understand why I might come up with a value that is different from someone else, so don't blindly listen to me or anyone in videos like this. Jimmy on Learn to Invest actually has some nice tutorial videos on how to calculate DCFs that I recommend you watch. And recognize that DCFs don't work out for all types of companies. Like if your company has unpredictable or volatile cash flows, then that can obviously make a DCF analysis less useful. Or if you're thinking that you can use a DCF to model how valuable a startup is that doesn't have lots of cash flow, then doing that probably doesn't make sense. Or if you have a cyclical company or one that reinvests heavily, leaving little to no free cash flow, then all that can lead to DCFs that might be too unreliable. Cyclical companies in industries like energy, automotive, or commodities often experience significant swings in revenue and profitability based on economic conditions or market cycles, which makes them challenging to DCF appropriately. A mining company may generate substantial cash flows during a commodity boom, but see near zero or negative cash flows during downturns, making long-term cash flow projections too speculative for useful DCFs. And then you have things like financial institutions, which don't have straightforward cash flows due to the nature of their operations, e.g. loans and deposits and such. So instead, valuation methods like dividend discount models or price-to-book ratios are often more appropriate to use. Another commonly used valuation metric are PEs, though PEs don't really work for REITs, and in fact classic DCFs don't really work for REITs either, and instead adjusted funds from operations are a more useful REIT valuation metric, as are net asset values, at least for property-heavy REITs. And dividend discount models are sometimes used for income-oriented REITs. Anyway, I often like to calculate intrinsic values based on a variety of objective and subjective criteria, and in this video I'll estimate where I think things will be a year from now, since I also like to include analyst projections that tend to be a year out to get an apples-to-apples sense of things. I know some of you don't care about analysts, but there are analysts out there with good track records, and websites like TipRanks actually rank analysts based on their historical performance and accuracy. Okay, now I'll jump into my stocks, and I'll go through my tickers alphabetically, starting with Apple, and I'll just call out a few interesting metrics, though I'm not going to talk about all the key risks they face or dive into financial trends that are normally critical to understand before you invest. Apple isn't a classic dividend stock, but it has been one of my favorite stocks, and I've made over 500% on it, even though it's a stock that I've only held for a relatively short amount of time, at least compared to some of my dividend stocks that I first purchased many decades ago. And that reminds me of a comment I just got on a video where someone saw my portfolio and said that my 4% starting yield is pathetic. I found that comments like that normally come from less experienced investors who haven't been in the market long enough to be able to understand why someone's portfolio is constructed in a certain way. They tend to be hyper-fixated on yield and often don't think about or realize how impactful stock appreciation can be over the years and how powerful dividend growth can be over time. They frequently don't diversify their portfolios, and they are often the ones who will end up quitting the market if their high-yielding tickers go bust, perhaps from NAV erosion or from ongoing diminished distributions. Anyway, my 4% pathetic current dividend yield is by design, and I encourage that commenter to try to understand if there's a method to my madness, rather than quickly conclude that a 4% yield is pathetic. Perhaps he should also consider how reliable my income has been, along with how it's been growing, and think about my total returns over time, and, well, I could go on about other important aspects to consider beyond just yield, but I'm guessing he also doesn't have the patience to watch videos like this to the end. I actually did a video for people like him, where I explained how I could easily make my portfolio have a 10% plus current yield, but I chose not to for a bunch of reasons. Anyway, I'm just some rando on YouTube, and just because I have a channel or whatever doesn't mean anything I'm saying is accurate or useful or has value, but I'd still encourage people to leave more constructive comments. Okay, Apple is 3.26% of my portfolio, and I calculated that it's expensive right now. Its current price when I did this video is $250, and my 1-year estimated intrinsic value for it is $230, which means it's currently 8% more than what I feel it'll be worth a year out. The specific rules I came up with is that if my estimated target intrinsic value is 10% or more above today's price, then I'd call it cheap right now because I anticipate it to eventually trend up. If my 1-year estimated target intrinsic value is 5% or more below today's price, then I'd call it expensive, like Apple is, and anything in between those two ranges I'd call reasonably priced. Analysts are also bearish on Apple as their 1-year target is at $244, which is 2.6% down from where it is today. Note, the analyst estimate is an average or median of often 10 or more analysts, so that helps weed out edge case super bulls or bears. And I'm not saying I'm bearish on Apple over the long term, I'm just saying that I estimate that it's overpriced based on my growth projections. Apple has a super low 0.39% dividend yield, a great 15% payout ratio, a mediocre 5.4% 5-year dividend CAGR, and an okay 13 consecutive years of dividend increases. Apple is clearly focused on driving more cash into buybacks than dividends right now. Next up, I have ABBV at 5.26% of my portfolio, and I find it to be reasonably priced. My 1-year target intrinsic value is at $182, which is 3.2% higher than it is today, but analysts are more bullish than me as their estimates are 15% higher. ABBV has a 3.74% dividend yield, a 57% payout ratio, a 7.7% dividend CAGR, and an awesome 52 consecutive years of dividend increases. Sometimes I'll get comments asking how I can say something is cheap when it's at an all-time high, and what they aren't realizing is that I'm talking about what I think something is worth, not what its price is currently at. Thus, even something at an all-time high can still be cheap relative to what I feel it's worth, and something can be expensive even if it's at a multi-year low. Okay, next up I have BTI at 3.27% of my portfolio, and I find it cheap. And again, don't blindly buy or sell anything based on my super quick analysis here. My 1-year target value for BTI is 21% higher than it is now, whereas analysts are slightly less bullish with 12% growth estimated. BTI has a huge 8.26% dividend yield, a 66% payout ratio, a low 2.5% dividend CAGR, and a great 22 consecutive years of dividend increases. I put an asterisk on dividend increases because those hikes are in British pounds, not adjusted for other currencies, which could make it such that a hike didn't happen. Moving on, next up alphabetically is Caterpillar at 2.4% of my portfolio, and I find it reasonably priced. I estimate it to be basically flat a year out, or rather about 3.5% down, but analysts are more bullish and have it at 7.6% up from here. It has a 1.54% dividend yield, a healthy 25% payout ratio, a nice 7.5% dividend CAGR, and a great 31 consecutive years of dividend increases. Then I have Colgate-Palmolive at 1.93% of my portfolio, and I find it expensive. I've got it worth 6% less than it is now, a year out, whereas analysts are way more bullish than me with estimates of 15.5% up from here. Hopefully they're right. CL has a 2.17% dividend yield, a 55% payout ratio, a low 3% dividend CAGR, and an awesome 61 consecutive years of dividend increases. Up next is Chevron, which is 2.33% of my portfolio, and I find it reasonably priced as my 1-year target estimate is a little over 7% above where it is today. Analysts are a lot more bullish as their 1-year target is up 21% from here. Chevron has a 4.56% dividend yield, a 56% payout ratio, a 6.5% dividend CAGR, and 37 consecutive years of dividend increases. Nice. I actually expect to see a dividend hike announcement from Chevron later this month. Next up is my first ETF, and it's an income ETF called DIVO. I didn't give my ETF's intrinsic value estimates, but analysts are bullish and they put it up over 11% a year from now. It's at a 4.63% dividend yield and has a 3.1% dividend CAGR along with 4 consecutive years of dividend increases as it's a newer ETF. After that I have Duke Energy, which I find reasonably priced, with my 1-year target basically going sideways, though analysts are way more bullish as they predict 16% upside from here. Now I bet you they're actually right, because AI energy demands could really drive the stock, though I still gotta stick with what I think it's worth, hype or not. It's got a 3.86% dividend yield, a 72% payout ratio, a low 2% dividend CAGR, and 20 consecutive years of dividend increases. Utility stocks often have slightly higher payout ratios because they typically operate in highly regulated environments with stable, predictable cash flows that can support those higher ratios. Next up I have Enterprise Products Partners, a master limited partnership that is 4.8% of my portfolio, and which I find is cheap. I have a bullish valuation of them, over 30% from where it is today, and analysts are also bullish but have it 15% up from here. It's got a hefty 6.78% dividend yield, a 1.61 coverage ratio, a 3.5% distribution CAGR, and 26 consecutive years of distribution increases. Master limited partnerships pay out in unit distributions, not in dividends, even though in casual conversation people use those terms interchangeably. MLPs are structured as partnerships, not corporations, and its owners are referred to as unit holders rather than shareholders. The unit distributions they pay out basically represent shares of the partnership's income. Distributions are often treated as return of capital for tax purposes, reducing your cost basis in the MLP units. Once your cost basis is reduced to zero, any further distributions are taxed as capital gains. This tax treatment differs from corporate dividends, which are usually taxed as qualified dividends or ordinary income. And since I hold DPD in my taxable account, it means my payouts are all at $0 of federal income taxes for the next 6 years until my cost basis gets to zero, which is pretty awesome. I mean, I make over $10,000 a year from EPD in my taxable brokerage account without having to pay federal income taxes on it, which I love. And I'm guessing they may do a distribution hike this month. MLP distributions generally come from the partnership's operating cash flow, not from earnings and profits like dividends from corporations. This structure is one reason MLPs are attractive to income-focused investors, as they can provide high tax-advantaged payouts. But they also come with additional complexities such as K-1 tax forms, which can affect tax filing. Now, I mentioned it having a 1.61 coverage ratio instead of its payout ratio because MLPs use distribution coverage ratio, which is the ratio of distributable cash flow to distributed cash flow. For example, if an MLP has distributable cash flow of $11.5 million in a quarter and distributes $10 million for the quarter, then the distribution coverage ratio is 115% or 1.15. A coverage ratio of 1.61 for an MLP means that the distributable cash flow generated by the partnership is 1.61 times the amount of cash distributions paid out to unit holders. In other words, for every $1 of distribution paid, the MLP generated 1.61 of DCF. And again, this is not discounted cash flow. So the ratio of 1.61 for EPD indicates a healthy and sustainable payout. It generally means that the MLP has more than enough cash flow to cover its distributions, as it's retaining a significant portion of its cash flow, or about 38% in this case. This retained cash can be used for reducing debt, funding growth projects, and for building a financial cushion for the future distribution stability. A high coverage ratio of 1.61 is likely to boost investor confidence, as it shows the MLP is not overextending itself to meet distributions. However, an excessively high coverage ratio, like 2 or more, might raise questions about whether the MLP is being too conservative with payouts or under-distributing relative to its cash flow. So it's a balance between rewarding unit holders and maintaining financial flexibility. To calculate that 1.61 coverage ratio, I looked at one of its recent statements and divided how much it could pay out by how much it did pay out. So for the 12 months ending September 30th, 2024, we see that EPD's distributable cash flow was $7.743 billion divided by the $4.8 billion it paid out, which gets us to the 1.61 number I calculated. This means that EPD generated approximately 1.61 times the cash required to cover its distributions during this period, reflecting a strong capacity to sustain and potentially increase future distributions. I looked at EPD's recent investor presentation and they showed a 1.7x coverage ratio, so I was looking over a slightly different time frame, but this shows how their 26 consecutive years of dividend growth have been well covered and that they've returned over $55 billion to unit holders via distributions and buybacks. Moving on, we come to Goldman Sachs, which is 3.25% of my portfolio and which I find reasonably priced. I've got it being worth about the same it is now a year out, whereas analysts are more bullish with it being up about 7.4%. GS is a 2.09% dividend yield, a 33% payout ratio, a huge 22% dividend CAGR, and a decent 13 consecutive years of dividend increases. Next up, I have Home Depot at 1.24% of my portfolio, and which I find expensive right now with its 1-year intrinsic value being 15% lower than it is today. But analysts are super bullish, pricing it over 13% from where it is today. Home Depot has a 2.31% dividend yield, a 60% payout ratio, a great 10.6% dividend CAGR, and a decent 15 consecutive years of dividend increases. Next up is the sister ETF to DIVO and its IDVO, the international counterpart, at only 1.05% of my portfolio, my second to last smallest position, and one which I recently got into. Analysts have a huge upside to IDVO at about 20% up from where it is today. It's got a nice 6.11% yield, and it's only been in existence for a couple of years. I generally don't expect for income ETFs to have much dividend CAGR growth, or even stock appreciation, generally speaking. And that leads me to JEPQ, which is 4.81% of my portfolio. Once again, we see analysts are bullish with it being up 14% from here, and it has a huge 8.71% dividend yield. These sorts of covered call ETFs have their various pros and cons to be aware of, including how they normally pay out mostly ordinary income, which can have tax implications for you. I actually bought my income ETFs with 100% profits for my dividend stocks, so that's kinda neat. Moving on, we come to a classic dividend stock in J&J, which is 4.44% of my portfolio, and which has been beaten down due to litigation concerns. I personally love it when an otherwise solid company is out of favor in the market, as that means it's often a great time to buy, assuming you're right in believing it will recover. I find J&J cheap, which is kinda a rare thing, and I calculate it's about 17% underpriced relative to where I feel its cash flow will be a year from now, and analysts are even more bullish with them saying it's 21% underpriced. It's got a 3.46% dividend yield, which is great considering its history, a 47% payout ratio, a decent 5.5% dividend CAGR, and an amazing 62 consecutive years of dividend increases. Next up is Kimberly-Clark, which is 2.32% of my portfolio and which I find is reasonably priced, with 5% upside from here. Analysts are far more bullish with 15% estimated upside a year out, and it's at a 3.74% dividend yield, a 66% payout ratio, a low 3.4% dividend CAGR, and an incredible 52 consecutive years of dividend increases. I expect to see a small dividend hike announcement from Kimberly-Clark later this month. Then I've got another popular dividend stock in Coca-Cola at 3.3% of my portfolio, and which I find reasonably priced, as I estimated its intrinsic value should be about 5% above where it is today. Analysts are very bullish on Coke with 17% upside from here. It has a 3.13% dividend yield, a 68% payout ratio, a 3.9% dividend CAGR, and 62 consecutive years of dividend increases. Next up is another classic in McDonald's, which is 3.79% of my portfolio and that I find is expensive, and I see it 10% overpriced even 12 months from now. Analysts see it 10% underpriced, so do with that what you will. It's at a 2.44% dividend yield, a 56% payout ratio, a decent 7.5% dividend CAGR, and 45 consecutive years of dividend increases. After that, we have a Puff Puff and Altria at 6.32% of my portfolio, and even with its run-up, I still find it's cheap, being 34% under its intrinsic estimated value. Analysts are much more conservative with about 4% upside from here, and I think it'll really come down to how their less harmful products perform and how regulations impact them. Realistically, analysts are probably more accurate in this case and what this price movement will be, but I'm hopeful that Altria continues to successfully move into a stronger product portfolio. Sin stocks always have ongoing regulatory risks they face, and in fact, as I was working on this section of the video, I saw that Belgium has just become the first EU country to ban the sale of disposable vapes in an effort to stop young people from becoming addicted to nicotine and to protect the environment. So as always, be careful and research before you invest. Next up is a stock that's not a classic dividend stock, though I think it will be, and I'm talking about Microsoft, which I find expensive. But analysts are hyped about its AI potential, amongst other things, and they see it at 18% up from where it is today. Now, I'm a big Microsoft bull, so me thinking it's expensive is merely an indication of where it is and where I think it should be valued relative to its current stock price. But hype often wins out over value in the short term. Microsoft is at a low 0.78% dividend yield, a 25% payout ratio, a nice 10.3% dividend CAGR, and it has 20 consecutive years of dividend increases. It'll be neat once Microsoft becomes an aristocrat, which I'm guessing it will. Next up is a classic dividend stock in Realty Income, which is 6.42% of my portfolio and which I find cheap right now, with 28% upside. Analysts are also bullish with 19% upside predicted 12 months out. Interest rates have rained on O's parade, which is why we see it down at these levels, which to me means buying opportunities, whereas others are running away. It's at a 6.01% dividend yield, has a low 3.6% dividend CAGR, but an awesome 26 consecutive years of dividend increases. Next up is another well-known dividend stock in Pepsi, which is 3.71% of my portfolio and which I find cheap right now. It's rare to find great stocks being cheap, so something to think about. Both I and analysts see about 20% upside to it in the near term, and it has a 3.57% dividend yield, a 66% payout ratio, a healthy 7% dividend CAGR, and a great 52 consecutive years of dividend increases. Next up is another classic dividend stock in Procter & Gamble, which is 4.1% of my portfolio and which I find expensive. I see it 7% overpriced as compared to analysts who see 9% upside. It's got a 2.41% dividend yield, a 58% payout ratio, a 6% dividend CAGR, and an amazing 68 consecutive years of dividend increases. Moving on, next up is another sin stock in Philip Morris, which is 2.56% of my portfolio and which I calculate is reasonably priced, going basically sideways into next year, though still down a few percent. Analysts are much more bullish with an almost 16% upside from here, so they're excited about their heat not burn products and such. PM has a 4.5% dividend yield, an 83% payout ratio, which is high for most companies but about where some stocks like PM normally are, has a low 2.8% dividend CAGR and a solid 16 consecutive years of dividend increases. After PM is Starbucks at only 0.9% of my portfolio, my smallest position. I wonder if Starbucks is still one of PPC's biggest positions. And if you've never watched PPC, then go check him out. He's like the OG YouTube dividend investor, and probably my favorite. I see 8% intrinsic value upside to Starbucks, while analysts have it at 14% stock upside from here. It's got a 2.69% dividend yield, a 70% payout ratio, a healthy 9.3% dividend CAGR, and a decent 13 consecutive years of dividend increases. Starbucks has been dealing with union risks that have been holding it down a bit, along with some other issues, but still it's one of my favorite places to go. Next up is a dividend ETF I own in SCHD, which is 6.99% of my portfolio. Analysts are bullish on SCHD and have it up almost 15% in a year from now. It's got a nice 3.65% dividend yield, a very strong 11.6% dividend CAGR, which I expect will slow down, and it has a nice 11 consecutive years of dividend increases. Next up is one of my utilities in Southern Company at 2.93% of my portfolio, and which I find expensive right now, as I got it down about 8% a year out. But analysts are far more bullish due to all the AI needs, and they have it up almost 14% a year out. It's got a 3.5% dividend yield, a 68% payout ratio, a 3.1% dividend CAGR, and 22 consecutive years of dividend increases. Second to last, I have Travelers at 1.19% of my portfolio, in which I find reasonably priced. I've got it out a little over 9% for a year from now, but analysts are a bit more subdued with the 5% upside estimate. It has a low 1.75% dividend yield, a nice 21% payout ratio, a 5.1% dividend CAGR, and a good 19 consecutive years of dividend increases. Finally, my last ticker is ExxonMobil, which is 4.14% of my portfolio and which I find is cheap, with almost 12% upside 12 months out. But maybe I'm being a bit conservative, as analysts have it up 22% a year out. XOM has a 3.74% dividend yield, a 44% payout ratio, a low 2.3% dividend CAGR, and 42 consecutive years of dividend increases. Please leave me a comment if you own any of these tickers, and if so, which ones, or if you plan to invest in any. If you don't own any and you don't plan to invest in any, then please tell me what you do own these days. Thanks, I really love hearing that kind of stuff from you guys. Okay, now we'll switch gears and I'll dive into talking about intrinsic values and stock prices, as that relationship is crucial for all serious investors to understand. I've shared this information in the past, but it's important enough that I recommend you rewatch it whenever I go over it. So here's a picture I made to show you how stock prices and intrinsic values usually work. It's important to understand that regardless of what a stock's actual intrinsic value is, the market often overprices it or underprices it, but in the long run the market gets it right as stock prices trend back to a company's actual intrinsic value. So I like to think of a stock's intrinsic value as gravity, or it's a magnet, as it's constantly pulling its stock price back to it. This was summed up in Benjamin Graham's famous saying, which is, in the short run the market is a voting machine, but in the long run it's a weighing machine. Voting represents how people are using their dollars to either buy or sell stock, which is why a stock's price is often a popularity contest in the short run. However, in the long run, the stock price trends towards its intrinsic value, which is analogous to saying that market forces slowly, but properly, price a stock, i.e. its real value is properly weighed and thus priced by the market. In the short term, the gravity of intrinsic value can lose out to more powerful forces like news headlines and world events and Reddit warriors. The market often overreacts to good news or bad news, which value investors can often capitalize on. What I mean is that people often buy or sell based on emotion rather than business fundamentals, which is why stock prices can do seemingly crazy things in the short term. But in the long term, gravity and physics and reality wins and stock prices trend towards actual intrinsic values, which are based on business fundamentals. That concept is super critical to understand if you want to be a good investor. It helps explain why certain things can be overpriced or underpriced for years, as stocks are popular or unpopular for years. But eventually business fundamentals win. If good growth comes, eventually the stock will respond. It can take a long time for people to forget about hated stocks or beloved stocks, but eventually they do if the company performs or doesn't perform. That's why you can see a crappy stock shoot up for a while, or a solid company trade in the dirt for a while. Your goal is to be able to identify when quality companies are cheap and then buy if it makes sense for you, or perhaps sell if things are too expensive. It all depends on you. Another gravity example I like is that dividend income is like the fuel or the thrust of your personal rocket, a rocket which is trying to break free from the gravity of your expenses. Once you have enough fuel and thrust, aka dividend income, to break free from the gravitational forces of your expenses, then you can blast away from your old life on Earth, then you can fly away faster and faster into space with the freedom of your time. Okay, now back to the picture. The blue line is the intrinsic value, i.e. my target price, i.e. it's a magnet or it's gravity, which is trying to pull the black line, which is stock prices, towards it. In this example, you can see an intrinsic value estimation that goes up and down as time goes on, and is slowly trending up like most quality companies tend to do over long periods of time. The black line, aka the stock price, tends to fluctuate wildly based on short-term news and headlines. The ideal time to buy a stock is when it's underpriced, which is represented as areas of red where the stock price fluctuates under its intrinsic value price. Now, if your strategy is to buy and hold for generations, then buying a stock at any price can work out. It's just that your returns will be less than if you buy when something is on sale, and it can take materially longer to get a good return if you just invest whenever. Similarly, the best time to sell is when it's overpriced, which is in a period on this graph along the areas of green, because those are all times when the stock price is higher than the intrinsic value. This example chart could represent 20 years or whatever stock prices, so you need to understand that something could be underpriced for years or overpriced for years, but stocks eventually tend to drive towards their real intrinsic values, which you can calculate with discounted cash flow calculation and evaluate using other approaches like PE trends. A low PE ratio doesn't automatically mean a stock is undervalued, and a high PE ratio doesn't necessarily mean that a company is overvalued, but a 15-ish PE is often a reasonable valuation for most, but not all, companies, at least historically speaking. So as earnings go up, then stock prices tend to go up, broadly speaking. That's part of why I like stock buybacks. As shares outstanding get reduced, all remaining shareholders own more of the company. Like if there are 100 shares outstanding and I own 5 shares, then I own 5% of the company. If the company reduces the shares outstanding by 10 shares, aka 10%, then there are 90 shares outstanding. Since I still own 5 shares of it, I now own 5.55% of the company. So you see, as they retire shares, each of your shares effectively owns a bigger portion of the company, so each share is more valuable. And as they retire shares, then earnings per share goes up. Remember, earnings per share or EPS is an important financial measure which indicates the profitability of a company. It's calculated by dividing the company's net income by its total number of outstanding shares. So if net income stays the same but shares outstanding goes down, then EPS goes up. As earnings goes up, then stock prices usually get pulled by that gravitational force and also usually trend up. Companies like Apple and Microsoft do some of the largest stock buybacks every year, which is why their stock gets extra wind at their back trying to push them up. Anyway, a conclusion you should draw from this picture is that the difference between a stock's current price and its estimated intrinsic value becomes your investing opportunity, assuming you believe the intrinsic value is a good estimation, and those who do invest like this are known as value investors, since they're transacting based on some form of fundamental business analysis, which attempts to calculate a stock's intrinsic or book value. Book value and intrinsic value are two ways to measure the value of a company, and there are a number of differences between them, but basically book value is a measure of now, and intrinsic value leverages forecasted estimates of the future. And remember, this info is for buy and hold investors. Day traders out there wouldn't find it useful. So when I share stocks that I feel are undervalued, it means I think it'll just be a matter of time until they revert back to their proper intrinsic value trend lines, though I have no real expectations of price movement in the short term. And if you aren't a fan of manually calculating DCFs and intrinsic values and such on your own, then I recommend you get a subscription to FastGraphs, which I'm an affiliate of, as it uses relevant metrics to automatically value companies. My FastGraphs affiliate link, along with my coupon code in the description of this video, combined, should allow new users to get 25% off their first payment, even if they sign up for a full year. Okay, time to wind things down, and now I'll tell you about my favorite Christmas present I got this year, and you coffee lovers out there will really appreciate this. So I got a new automatic espresso making machine called the Ninja Espresso Luxe, and I gotta say I absolutely love it. I've been researching getting an automatic espresso machine which can take coffee beans, grind them up, and serve up espressos that also has steamed milk and stuff like that. Ninja came out with this earlier this year, and I've seen a bunch of coffee YouTubers talking about how amazing it is for the $500 price. It does cold brew and drip coffee and all that jazz, and it's super easy to use. I've loved my espresso, but I wanted to raise the bar on quality and health, and I'm super stoked that I got the Ninja. I rarely pitch stuff like this on my channel, but if you've been thinking about getting an automatic espresso maker for a reasonable price, then consider using my Amazon affiliate link for it, as that's a great way you can help support me without costing you anything extra. Just drop me a note if you do it so I know who showed me some love. And regardless, please leave a comment if you love coffee, and tell me how you make yours and what type of coffee bean brand or whatever is your favorite. And with that, I ask that if you made it to this point in the video, then please show me some kindness and hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Now I'd like to shout out my newest Patreon aristocrat, Ken H., who just snagged a recently opened Patreon seat. I'd also like to shout out Buffalo Rules 2014, who just signed up as an aristocrat for an entire year. Aristocrats gain access to my dividend spreadsheet product, which I use to track my portfolio. They also gain access to private channels on my Dividend Discord, where I tell you about what buys or sells I'm doing or plan to do, along with they often get to influence what videos I create, from suggesting new video ideas to voting on which YouTube thumbnails I use, and they get to watch my videos before I release them publicly on Saturday morning. They also get shoutouts like you just heard, and they get to be on my scrolling video news ticker. And now I recommend you check out my Seeking Alpha affiliate link in the description of this video, as new users often get discounts for signing up, and I find their articles and comments quite helpful. And last but not least, and sorry for my voice change, but I just re-recorded this section to thank a new channel member, Dennis S., who recently clicked that join button. Finally, don't forget to join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 83 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.